All right, hello everyone. My name is Vinh Nguyen, but you can call me Vinh. And my research partner is Zhao. And our talk tonight is all about single stock ETF. But before we start the presentation, I want to bring up my research partner, Le. Come on up, and she'll introduce herself and say a few words.
Hi everyone. This is Zhao from Department of Finance, Real Estate and Business Law. Thank you everyone for coming here. I just want to share a quick story about why we want to do this research and how does this research come from. So when I first heard about single stock ETF, I was shocked because from my understanding, ETF looks like portfolios that people just put a lot of fun to design a portfolio, and we call it ETF. But how does a single stock ETF works? I have no idea about that, and I don't know how does that work. Yet at that time, that product is already in the public and everyone can buy it. So out of curiosity, I started to have a conversation with Vinh. We started to discuss about this thing. We're like, how come we can have a single stock ETF and what exactly it works? Then we started to do more research and we come up with this paper. So I really hope you enjoy this paper and hopefully you can get more understanding towards single stock ETF, and we hope our finding can help you to have a better informed investment decision. Thank you.
Yeah, great. Thank you. All right, so similar to Le, I became interested in this topic because I wanted to know more about this brand new investment product, right? And to give you a little bit insight into sort of what I do, I started investing when I was 15 years old. And part of the investing mind is thinking about what are the returns, but then also what are the risks involved, right? So you can't just have one without the other. So when it comes to looking at single stock ETF, we ask a really important question. Is it a high risk bet or is it a strategic investment tool? So now in 10 minutes, every single person in this room should be able to answer that question yourself. But first, a disclaimer. Le and I are not licensed financial advisors. So if you are going to make investment decisions, please seek the help and advice of a licensed professional. All right. Okay, so now that's out of the way. Let's lay the foundation and understand what is an exchange-traded fund first. So an ETF is a basket of investments that range from stocks to bonds. And these funds are traded on an exchange similar to how a stock would be traded. And these funds provide diversification, right? But at a very low expense ratio. What's an example of an ETF? Well, the most popular ETF is the SPDR S&P 500 ETF. This ETF mimics the performance of the S&P 500 index. And this index essentially is a portfolio of the top 500 largest firms in the United States. And so what this ETF provides is, again, diversification at a very low expense ratio while averaging a 13% return per year in the last 10 years. That is a very good return rate, nothing to sneeze at. So this particular ETF invests in 10 different sectors, primarily in tech, also in financials and consumer discretionary. When you look at specifically what are those top companies, well, number one is NVIDIA. Apple is number two, Microsoft, and then Amazon, which is actually in consumer discretionary. All right, so now that you know a little bit more about what is an exchange-traded fund or an ETF, now I can talk about what is a single stock ETF, right? So a single stock ETF, that was introduced back in the summer of 2022, and it essentially tracks the performance of one single individual stock, all right? What is its purpose? Well, one is, yes, it can track the performance of a single company, but it can also amplify the performance of that company. And I'll explain a little bit more about that coming up pretty soon in the next slide. Secondly, it also allows for the investor to hedge any short-term risks associated with that particular company. So what are some examples? Well, there are single stock ETFs on Tesla, on Amazon, on Nvidia, on Pfizer, and on some of the companies you may already own as well. All right, so now when you look at single stock ETFs, in terms of the magnification, the return amplification effect, there are two main scenarios we can look at. Let's focus on the green box first. The green box is sort of our example of a 2x single stock ETF, where if you were to buy this single stock ETF, it can double the return for that particular day. So let's use Amazon as an example. Let's say Amazon has a good day, a return of 5%. The 2x single stock ETF will provide a 10% return, so twice that, right? But then what if you're not so optimistic about Amazon? For example, today was their earnings announcement, right? And you're not so optimistic about the earnings of Amazon, and you think the stock price will go down, but you still want to benefit from that drop. What would you do? You would then engage, or an investor rather, would engage in buying a negative 2x single stock ETF, which is the box in the red there. So when Amazon drops by 5%, the single stock ETF, the negative 2x single stock ETF will actually go up by 10% there. So as you can see, this is a major benefit in owning a single stock ETF, and that is for the return amplification effect. What is an example? Well, Direxion has a single stock ETF on Amazon, and it's traded for about $48 per share. So relatively cheap per share when it comes to the actual stock of Amazon, right? So how is this single stock ETF made? Well, it's comprised mostly using derivatives in the form of swap agreements with financial institutions. All right, so I've said a lot about benefits, right, of single stock ETFs. And as I mentioned to you before, with me when it comes to investing, I like to know about the returns, the rewards, but I also pay a lot of attention to the risks. So let's talk about the risk. The first one being that all your eggs are in one basket. There is no diversification here. What does that mean? Well, in a traditional ETF, you are investing in a basket of very diverse stocks, 500 different assets, right? But in a single stock ETF, you're focused on the performance of one single individual company. So if something were to happen to that company, let's say Amazon, right? That not only will that affect the stock of Amazon, but that will also affect the performance of the single stock ETF. So really, you are exposed to a lot of firm-specific risks. Secondly, there are tracking errors. So what do I mean by that? Well, let's take a look at this table here and focus on the second column. So let's say from day 0 to day 1, there was a 5% increase in the stock price. And then the following day, a 4% decrease in the stock price. And then the following day, a 3% increase. So cumulatively, the individual daily return should give you about a 4% return, right? However, when you look at the single stock ETF and just the 1x, which is mimicking, tracking the return of that particular company, there's already tracking errors. So you can see that if you were to hold the 1x single stock ETF for 3 consecutive days, the 3-day holding period return is not 4%. It's actually 3.82%. And then it gets worse. Look at the 2x single stock ETF. So 4 times 2 should be 8, right? But is the 3-day holding period return 8%? No, it is 7.27%. And then look at the negative 2x single stock ETF. It should be negative 8%, but it is not. So clearly, if you were to hold the single stock ETF for more than 1 day, you are exposed to tracking error risks. 3, management fees. Nobody works for free, right? I don't. So single stock ETFs tend to have really high management fees, and we call that expense ratio, right? On average, the expense ratio for single stock ETFs is 1.1%, whereas traditional equity ETFs, the expense ratio is about 0.16%. And now you might think, Vin, it's only 1%, like relax, take a deep breath. But then let me tell you this, what if your return is 4%? All of a sudden, a quarter of your earnings, poof, gone, right? Gone. So it is kind of a big deal, and it's something to consider. All right. Then the next risk is liquidity risk. All right, so what is liquidity? Liquidity is the ability for the investor to buy or sell that particular investment very quickly at the desired price, right? So the higher the liquidity, the better it is for the investor. Well, based on the research that La and I did, the liquidity for single stock ETF is very low, especially when you compare that to the underlying stocks. So on average, the daily trading volume for single stock ETF is only 225,000 shares only. And then when you look at the daily trading volume for the underlying stocks, it's 50 million shares a day, right? So there is a significant difference in terms of liquidity, and it is a problem that single stock ETFs have right now. So connecting with liquidity is volatility. When liquidity is low, volatility is high. However, there's good news. So since its introduction in the summer of 2022, single stock ETFs have gotten more popular. More people are interested. So the trading volume has risen slowly. So what that means is liquidity has improved slowly, which has helped to decrease volatility since its inception. But remember, volatility is still high. Although it's decreasing, it's still high. So it is still a risk to consider. And now, you know what all the risks that I thought about for single stock ETFs. But then guess what? Regulators have even issued warnings. So looking at the SEC and FINRA, they both have warned investors about single stock ETFs, about how new they are, how complex they are. And so they've warned investors to stay away if you're not a seasoned professional, right? So consider yourself warned. So now I'm going to go back to my main question, and let's see if you can answer this question, yeah? And it's just in your head, you don't have to say it out loud. So what is it? Is it a high-risk bet, or is it a strategic investment tool? It's both. It's both. It's both. So it can definitely be used speculatively as directional bets, right? However, if you are strategic, which I should say if investors are strategic, you can actually use it to hedge very short-term risk and eliminate some firm-specific risk for the short term. So it can be used as both. All right, I'm going to conclude this presentation with 3 final remarks. The first one is, if you're going to invest in, or rather if an investor were to buy a single stock ETF, he should really understand the underlying stock. So really understand Amazon if you're going to buy a single stock ETF on Amazon. 2, think about the liquidity. Think about the daily trading volume for that single stock ETF. Some will have higher liquidity, some will have lower liquidity. 3, be careful with the volatility. Be cautious, especially with the 2x and the negative 2x single stock ETFs, because those ETFs, single stock ETFs, can really move quite quickly, right? So thank you very much for listening to our work. La and I have actually published 2 other articles on single stock ETFs. And if you were to scan our QR code, it will take you to our website, and it has our contact information, but also the articles as well. And the latest one you can actually read for free. All right, so thank you for your time. I hope you enjoyed it.